Hello everyone. Today we're going to be looking at some tips and some rules for beginning in investing. I'm assuming either most of you are very brand new to investing, or maybe you just want to hear what my opinion is on rules for investing if you're new. But today I'm going to be diving into 5 separate rules in order of, I think you need to know them before you start investing. This goes both for individual stock investing, but also for index funds. So those, even if you don't know anything about a stock, you don't even know what a stock is, hopefully you can learn something from this video. Sorry for that rustling noise. The first rule I have is always do your own research, right? So videos like this, right, is part of research, but it's not enough. There's a lot of really good YouTubers that provide great information about stocks and investing and, personal finance. There's a lot of good personal finance stuff on YouTube as well, and that's all good. However, you need to do research on your own as well. Like, I don't think one video, one person, however great they may be, is enough to fully know. Because as much as you may trust someone's opinion on something, they could be wrong, right? You don't really truly know unless you do your own research. So, that involves everything from looking things up, going on different websites, whatever that may be. Remember, although investing is awesome for building wealth, it's probably the best wealth building tool other than income. It's so important to do your own research and just look at things. Even like if you want to invest in Apple, right? Just do, news on Apple stock, right? Something like that. Or stock news now if you don't know anything, if you just want to see what people are talking about. Things like that. Read an article, start to get familiar with the lingo. If you have cable, something like CNBC, it's going to seem like really crazy at first, but I know I'm not just saying watching TV is enough for it, but step 1, you need to do your own research and just look into these things. So step 2, do not invest what you can't lose. I personally scroll through stock investing subreddits, many different ones, everything from personal finance to money to stocks to dividends. I look at all that stuff. And it seems whenever the market is going down, you have one of these, or even one of these, right? Or even one of these. This is COVID, when it went down a lot. It seems like people always panic. And I think there's mainly 2 reasons. One is just like, oh, it's my money, I'm losing it. That's important too. But I also think a lot of people have too much money invested that they shouldn't. So I'm not a personal finance channel. I'm not going to adhere to that. That's not my niche, although I know a lot about it. But one rule is, inside of this rule, is if you have credit card debt of any kind other than it's going to be fully paid off and it's what you spent this month, you should not be investing. You shouldn't. 401ks may be different, get that match because that's good return. But outside of 401k, even Roth IRA, you should not be investing. That is just one of the rules. Is wealth building is awesome, but I guarantee you credit card debt. This over the last 5 years, you've gotten a 94% return on the S&P 500. That's basically what this is. It's Vanguard's tracker of the S&P 500. And over the last 10 years, you've done 200%, which is awesome. That is great. But it's nowhere near what credit card debt would have you. Just do the math on what you're losing to interest. It's insane. Right now, because rates are so high, it's close to 30 for most cards. 30% every year. And it differs a bit because that's a bit more complicated than that. But so do not invest more than you can afford to lose. More than you can afford to lose. So even if you don't have credit card debt, if you have kids, right, and you don't have an emergency fund, right? Maybe if you're a 22-year-old single guy living in, your own apartment or something like that. Yeah, sure, 2 to 3 months, of an emergency fund is probably sufficient. I would prefer more, but you'll be okay, assuming you have parents and other people you lean on. Worst case scenario, you lose your job, market just goes down, and you have to move back into parents. That sucks, but you're not going to go bankrupt. If you have a kid, right, and you're putting significantly more into investing in single stocks or even outside of that, and you do not have a 6-month emergency fund, you should probably not be investing. But outside of that, and if you're paying this is going to go towards rent, but I'm just going to have the stock market for a little bit, or I'm going to buy a house with this money, but stock market returns, I understand if you're very new to this, but you should not be investing more than you can lose in the long term. 5 years, if you absolutely need that money within 5 years, you should not. Now, it's like, well, I might buy a house in 4 years, but I'm okay with buying one in 6 years, right? Or 3 years, and I'm okay with buying it in 5 years. Then maybe, sure, as long as it doesn't really matter that much. But you should not be investing money in the stock market. Unless you don't need that money for 5 years. Because something like 2007, if you put a lot of money in 2007, you really wouldn't have gotten it back to that level till around 2013, which is about 5 years. That's generally the longest recession you'll have for the S&P 500, something like that, where your money loses value. So that's why they say 5 years. And I agree with that personally. So, and emotions, when markets start falling, emotions get evoked, usually negative. Oh, I need to sell. Oh, I need to sell, which is actually the inverse. You should always be buying on dips, right? Maybe you just don't have the capital. That's fine. If you lose your job, obviously, clearly you need to rely on your emergency fund and you can't invest. That happens during when bad things happen in the economy, people lose jobs. That is understandable. But if you're selling whenever the market drops, you're literally selling at the worst possible time. That's worst you can do it. So and now you may be like, I still don't even know what a stock is. Why are you telling me all this stuff? And I get it. I promise we'll get there. But you need to understand one more thing first is understand your risk tolerance. On this channel, I like to look at individual stocks. I like individual stock investing. I can put more into the market of my money personally, investing in single stocks, even if I do underperform the market. I haven't so far, but it's only been, it hasn't been a long enough time frame for me to say, oh yeah, I'm always going to beat the market. And I've never claimed that, right? Other than I guess I just did, but it's complicated. But anyways, understand your risk tolerance. Most people should not be buying single stocks. You shouldn't. Most people should not be buying single stocks. There's no need. Most people should be investing into, an IRA, their 401k, and just buying 500 index, something like that, maybe a growth mutual fund, stuff like that, and you're going to do just fine. You don't even got to worry about it. And you're going to get great rates of return. That's for the majority. I'd say 80+% of people should be doing that. Maybe that's too risky for you. Another 10% will say, I know I'm going to make a lot less money, or I hate with my money being tied to the stock market. I don't get it. I don't understand it all. And they'll only do CDs or bonds or things like that, which it's fine for some of that. You should absolutely, in my opinion, be invested in stocks. They're such a long track record of performance. It's weird how the max doesn't show the dot-com bubble. I assume this was Vanguard 500 was founded after that. But anyways, that's a side tangent. Understand. But some of you are 22 and you really can't get motivated by just putting some of your money into the S&P 500, and that's fine. And you should be investing in single stocks, and maybe not. I don't know. If you can't invest otherwise, you probably should do that. Although you need to do a lot of research. But if you're 22, it's okay to be dumb with money and lose some of it, right? Even if you do terrible invests, it's not really going to matter. If you're 22 and you have 2 kids and you're married or aren't married and still have 2 kids, you shouldn't be playing around with that money. That's a different story. But you need to understand your risk tolerance. Also, maybe a little higher. I personally will never do options. I am not a fan. I don't think it's investing. I think it's trading. Maybe you want to be a trader. That is up to you. It's not investing. Maybe you're good at it. Some people make money doing it. A lot of people do not. And a lot of people have that opinion on the stock market in general, which is just wrong. But maybe you just want to trade stocks. Maybe that's what you like doing as a hobby, right? But that's not investing, and that's not saving for retirement. And that's not saving for a kid's, college and all that. That's not what that is. That is, that's just different. Now, like I said, maybe that's your thing. Maybe you enjoy it. Maybe you make a little bit, 1%. You still like it. There's a difference between options trading and swing trading. Swing trading, I just usually think is just an inferior version of investing, but generally you will make money, assuming you're not just doing like penny stock trading, right? But swing trading, just because stocks do better in general, so of course statistically it's going to go up when you hold the swing trade, right? Anyways, that's diving a little bit too much in the weeds, but you need to understand your risk tolerance. Research what trading is, what option is, what is investing is, what ETFs are, what individual stocks are, and determine what is right for you and your situation. I would always go more conservative if you truly don't know, but anyways. And number 4, and that kind of builds off what I got into last time, is understand what investing means. What does investing mean? Investing and trading. Oftentimes, I'll even see it on Reddit. People will say, oh, yeah, I just got into trading. And then the post they'll say, oh, yeah, I'm invested in this stock, right? Or they'll say, oh, I just got into investing. It's like, what are some good trades you see? That's not the same thing. It's like, oh, yeah, I put on the NFL game the other day in Alabama and Vanderbilt just beat Alabama. That happened yesterday in real life if you guys are watching this in the future. So that's why I mentioned that. But you'd be like, well, Alabama and Vanderbilt do not play in the NFL. They play SEC college football, or maybe you're European, like, oh yeah, I was watching the Champions League, or maybe that would be a bad example. I was watching the Premier League yesterday, and Ipswich was playing. Ipswich is in the Premier League. I'm butchering this. Premier League, and Bayern was playing Union Berlin, whatever. Right? I'm a soccer nerd as well. Even though I just completely destroyed that soccer. For an American, I am a soccer nerd, but for a European, I'm not. But it's like, it doesn't make any sense, I don't know. Maybe you're totally not a sports fan. Yeah, I was, I went on vacation to Thailand and I saw Tokyo, and it's like, what? It doesn't make any sense. Trading and investing are two completely separate things. Traders are looking at a stock, generally, or the market in general. Maybe they generally do not do S&P 500. So let's outside of options, traders are looking at a stock and saying, this stock, I believe, because of X reasons, this is going to shoot up, right? Within the next month, 2 months, 3 months, maybe even year, right? This is an undervalued stock, and I think it's going to shoot up. That's generally what traders are saying. Investors are saying, I like this company, I like their leadership, I like what they're doing, I like their product. I don't know where the stock is going to go in the next year or 2 or 3, but I know as long as they continue to do what they are doing and what they have been doing, I will make money. Or I don't know much about in stocks and investing, but I know generally stocks outperform any other type of investment. I mean, there's other types of investment, right? But it's the easiest, right? People give you matches on 401ks. It's already in the account, right? Things like that. So maybe you are better at real estate and then do real estate, right? But this is about stock investing, right? So I know generally, even though it goes down, historically, there is no better wealth builder that's this simple than investing in the S&P 500 or VOO or other index funds that mimic the market, mimic the top performing stocks, and you will just make money. That is your understanding. Is I understand that, companies are doing better and better, innovating more and more and more. So, but you have to understand the difference between investing and trading. They are two completely different things. They just use the same thing. They both use a ball, but they are a different sport. Or they both use a football, but one is the NFL and one is college. They are different. And the last one is learn from your mistakes, right? You are going to lose money investing at one point or another. If you hold it, and you look at it from the mindset of my money goes up day to day, you are going to at times have less money. It's just going to happen. It's going to happen. You will have more money, right? In investing, and it's certainly in the broad market. Maybe if you do individual stocks, maybe you'll lose money and learn that's not for you. But in that case, too, learn from your mistakes. And going down isn't necessarily a mistake, right? But certainly this applies more to single stock investing. Or if you do panic and you do sell low, and then it goes back up and you're like, oh, I thought I was going to keep going down, man. I just messed up, buy back in or do whatever you need to do, but learn from your mistakes. Take the information, right? It's the same thing with it doing like a test or something. If you fail a question on the test, you don't go, oh darn, I'm just going to put the same answer in, and maybe the teacher will mess up and they won't notice I put the wrong answer in again. Or you can learn, study the question, and then on the next test or the final, you can get it right. I like how I didn't even really use Charles Schwab at all. I was going to use Apple as an example initially, but I thought it'd be better to use S&P 500. So anyways, I'm going to dive a little bit into, just learn from your mistakes. But assuming I did say I go from a person that has no idea what this stock is. So in case you don't know what a stock is just a share in a company, right? So 1 share of Apple is an investment into the company of Apple. You literally own a portion of Apple, right? Everyone who owns Apple owns a certain, now there's some different types of shares for like extreme shareholders, but usually it's only voting rights, right? But something like the S&P 500 is, instead of owning 1 share of Apple, you're owning 1 share that is broken down into 500 different pieces of the top 500 companies in the United States. That's what or like a broad market, it's literally one of all the little ones. So when they all perform better, which it's like, well, how does it keep going up if all of them do different? Generally, the market kind of just follows a pattern. And even though different stocks are doing different things, a lot of them are just kind of following the same flow. So this is what you get. You just get the big flow. And now I know that maybe not everyone understands that, but hopefully those are some rules. So next time we'll get into more financial side of things. I'm going to do a follow-up video talking about the more financial side of things. That's literally what I just said, but I reiterated it. So going into like how to value a stock, is maybe you're one of those people, oh, it's just too high right now. The S&P 500 is too high right now. If that's your opinion, yes, but I want to see how people can understand to do it. The next one will apply more to single stocks generally, but it'll still apply to everything as well. Hopefully it's all good information. So anyways, I hope you enjoyed this video. If you agree with me, disagree with anything, let me know down in the comments. If you did like the video, I would appreciate it if you left a like on the video, because it actually really helps the algorithm out a lot when people leave likes and things like that. So anyways, I appreciate you guys all for making it this far, and I'll catch you next time. See you later.